Hello everyone, I'm here again with Gary Reynolds for an update. It's been a couple of weeks since I've seen him, so I thought we'd catch up and get an update directly from the investment team. Gary, hi. First of all, how have the funds been holding up over the last couple of weeks?
Well, they've done actually pretty well. Obviously, we've taken some losses in these markets, but they're not big. We've not been in the ranks of the sort of some of the big growth funds that have been absolutely hammered. We've been well diversified. That's been a benefit, and we didn't have anything directly invested in any Russian equities, and very little in emerging markets generally, actually. So I guess so far we've done fine. It's been good. I'm hesitant of being too upbeat on that because you've still lost a bit of money for clients during this crisis, but relatively we've done extremely well. And as all clients know, particularly those that have been investing with us for over 30 years, you go through a series of crises. Up and downs is the price the equity investor pays for the long-term outperformance. And as long as you've got some capital set aside for emergencies, with which I know our advisory team make sure our clients invariably have, and also for immediate capital expenditure, if you've got that cash, then you sit it out and you get on with things, and that's effectively what we're doing.
Has there been any changes in your strategy with regards to the ongoing tension? I mean, things aren't easing at the moment. We're not sure where things are heading. How has that influenced you and the team?
Well, I guess before this broke out, technically, we could have, if we'd wanted to, bought stocks in companies like Rosneft and Gazprom. And I guess today we definitely wouldn't be buying those stocks. And, we'd be very, very careful, even of companies like Evraz, which is UK quoted. It's Abramovich's company. So we're not keen to get involved in any stocks like that. I think you've got to respect what the world is trying to do to impose the embargoes on Russian finance, to make them pay a high price for invading an independent sovereign country. And so we would be mindful of not violating any of the spirit of the sanctions, as well as the letter of them. But the truth is, Leo, what you have with wars is a massive amount of uncertainty. They bring more uncertainty than anything else. Will they escalate? Will they just fade? Wars have been around for as long as mankind has been on this planet, and actually things are a lot more. Things are actually more peaceful these days, funny enough. I know it doesn't feel like it when you see these types of conflicts on the go, but it's been a fairly good 70 years post Second World War. So when you get into a conflict like this, you have to be mindful that there will be a lot of unknowns. So we're very careful with liquidity. We are looking to see whether anything we might want to buy has got any risks that could come to the fore as a result of the Ukrainian crisis. But I've got to say also, you look for opportunities. You look for stocks that have been punished by what's happened, because when you get uncertainty, the market tends to operate indiscriminately. So good stocks get punished as well as bad ones. And you really saw that in the spring and summer of 2020. And again, we're looking for companies that, have been oversold and actually would be able to weather this difficulty. And I just would say one more thing. History teaches you that, and there's piles of evidence on this. There's a very good book by Barton Briggs on equity markets and wars, which he wrote in 2008. But if you track that, companies tend to come through wars. The bonds of the losing nations tend to be the worst asset to be in, and sometimes even the bonds of the winning nations, because you can get inflation post a war. So we're mindful of that. But as we're very short duration and in good quality bonds, I'm hesitant, Leo, of saying I'm really happy with the situation we're in, because I'm mindful that people are dying, families are dying in a country in a filthy, nasty conflict. But if we understand the humanitarian side is what should concern us most, and then we get to the monetary side, we're positioned fine. I'm very comfortable with where we are.
If I look back to the beginning of the pandemic, look at the total return growth fund, for example, that dipped down to around £1.50 fund price at the time. At the moment, the fund price is sitting just under £2.50. So yes, I've seen the funds go down. I saw a slight uptick over the last 24 hours. Is this going to go as far down as it did when the pandemic hit? What about the word recession that people are talking about? Are we prepared in that event?
Well, what you have within our portfolios is that we're looking for assets that are good value. In the old-fashioned way of describing them by Benjamin Graham in Security Analysis in 1934, you want stocks that are underpriced with a margin of safety. And that means you can stick out the ups and downs and work your way back again. So your description of where our growth fund, which obviously is above average risk compared to our other multi-asset funds, so it will be the most volatile, loses ground, quite a lot of it, in the summer of 2020, and then climbs back. And if you look at the metrics for it, it shoots the lights out over virtually all time periods over the last 10 years. And what we try and do is make sure we've got assets that, even if they're punished by short-term market sentiment, nevertheless represent good long-term investments. So you can stick it out, and you have to be patient. And that is very much what you've got to do in this situation at the moment, because wars are periods of enormous uncertainty. They bring more uncertainty than virtually anything else that can hit a market. But very often in conflicts, markets start to discount the end and pick up strongly. So you in terms of the effect on asset prices, the worst is a financial crisis, which will tend to depress for a longer period, which you saw happen in 2007, 2008. Wars do have a negative effect, but they tend to affect bonds more than they affect equities. And we've got very little bond risk because we've been keeping our durations. We're holding lots of short-dated stuff, which means irrespective of what happens to interest rates, it's not going to affect the value dramatically. Which is why our bond fund is actually, which is uber cautious, is one of the best bond funds over the last year. It's because of that short duration. So we're not picking up the pain from the interest rate hikes, which I've been forecasting for quite a while.
Gary, we'll leave it there. Thank you for your time and for your insight, as always. Ladies and gentlemen, I hope this helps answer any questions you might have. Thank you for the questions that you've been sending through. And if you do have any more, please send them to us and we'll get them to the right people. Thank you very much.